And here we are again. Today's video is going to be on moving averages. My name is Kofi, your admin for this channel. We are back again with another tutorial that will help you build your knowledge in terms of Forex. We are here to help every individual on this channel to trade the right way and to make money the right way from the Forex market. If this is your first video on this channel, we have a playlist. We have free Forex training playlist, and then we also have the Forex Signal playlist. The Forex Signal playlist is our forecast or signals that we provide every weekend of the week. Every weekend, we come your way with a signal, and that signal is to be traded, okay? So that is that about the Forex signals. If you want to get our signals, then you need to be on this channel every weekend. And once you're on this channel every weekend, I'm sure you will surely get the signals. Now, the Forex training tutorial aspect of the playlist is to help you become a Forex trader. If you are new to the Forex market, even if you are already a trader, I'm sure there are information here I share that will help you and guide you to become a better or more experienced trader. So come along with me, subscribe to this channel because we have a lot coming. We have a lot. So just go to the free Forex training playlist or you go to the Forex Signal playlist, depending on what you want on this channel. My name is Kofi, your admin for this channel. So just as I said, today we are talking about moving averages. Let's go straight to the chart and look at what we want to share with you today in terms of moving averages. Here we are. So I'm going to do away with this video so that you can actually see whatever we are doing here well. So I'm stopping the video. Sorry, the video in terms of my face, so that the actual tutorials will be seen clearly. All right. So here we are. Today we are talking about moving averages. Have you ever heard of moving averages? How did you get to know it? Or what did they tell you in terms of moving averages? Now, let me say something to you. I want to say something to you, okay? And whatever I want to say to you, I want you to see my face whilst I say that to you, okay? So let me say this to you. Now, when it comes to moving averages, I'm sure you might have heard of the word average, which is an English word, very easy to understand. But for all of us to understand it better in terms of the Forex market, when we say something is on average, let me give an example. For instance, I am in Ghana, okay, in West Africa or in Africa, Ghana, that's where I am. When someone says, okay, when you take the ladies, the beautiful ladies in Ghana here, when you take about 10 of them and you want to find out on average their beauty, okay, what will be the average beauty of 10 ladies in Ghana? So those 10 ladies, one can say, depending on the calculation or the description to which beauty is given, one can say that, okay, when you take 10 ladies in Ghana, out of the 10, 7 are beautiful, or on average, 7 are beautiful. When you hear the word on average, 7 are beautiful, what it's simply telling you is that when you add the 10 ladies, their beauty all together, and you divide it by a certain formula or a certain what do I even use? I'm looking for the right word to use. When they divide it by a certain yardstick, okay, or certain rules, you can say that, okay, out of these 10 ladies, 7 on average are beautiful. It doesn't mean that they handpicked 7 ladies to say they are beautiful. They added all the 10, the beauty of all the 10, and then on average, they got 7 out of the 10. So once they say 7 women or ladies out of 10 in Ghana are beautiful, it means that on average, that is what it is. Now, if this example is not clear, let's go straight to the chart and go to the slides so that we can really look at what moving averages is all about. Now, here we are on moving averages. Today, moving averages, when we say moving averages, what we simply mean is that we are going to be looking at some topics, and these topics are going to be very interesting. We're going to have a topic like simple moving averages, which is in short, SMA. And also, we're going to be looking at another word or topic like exponential moving averages, which is EMA. Another phrase or sentence that we might be looking at is this SMAs, which is the simple moving averages versus the exponential moving averages. Which one is good to use? Is it a simple moving average or the exponential moving average? We'll be looking at that. Again, we also be looking at how to use moving averages to identify a trend in the forex market. And also, we will be looking at formulas, strategies, how to use these moving averages in terms of trading. And one of them is moving average crossovers. That is one of the strategies of using moving averages. So we're going to be looking at that strategy. Maybe, who knows, it might become someone's best strategy to use in the forex market. So we'll be looking at moving average crossovers. And then we'll also be looking at using moving averages as support and resistance. That is also another strategy. So we'll be looking at that as a strategy. And then the last one, or maybe we'll also looking at, or we'll be looking at moving average envelopes. Okay, we'll be looking at moving average envelopes. This is also another strategy that people use moving averages in trading the forex market. So when it comes to the moving average as a topic, we are going to be looking at strategies that you can actually use these moving averages to trade the forex market. If you agree with me and you love what is about to happen, please subscribe to this channel and then also like this video. All right. So quickly, you know how to contact me in case you have a one-on-one discussion or something you want to tell me. My Telegram handle is @KofiDollar, @KofiDollar. And then my email address is leadingforegh@gmail.com. My phone number and WhatsApp number is +233 246 136609. Okay, quickly, Leading Forex, what are we about? What do we stand for? What is our vision? What's our mission? What do we want to do by bringing you this channel? Or what do we want to achieve? All we want to achieve is to become an alternative in the status quo, which is Forex, or maybe online money-making status quo that you are stuck in. We want to help you out of that status quo that you are stuck in. That is our mission on this YouTube channel. So please subscribe to this channel and expect nothing but more. All right. Now, enough. Let's go straight into the topic, moving averages. When we say moving averages, what are they? Now, let's take this point carefully and please take notes if there need be. A moving average is a technical tool. So it is under technical analysis, okay? So moving average is a technical tool which is used to smooth out price fluctuations to help you distinguish between typical market noise and actual trend direction. Now, What we're trying to say with the first point here is that the forex market moves in zigzag. It moves in rough, if you put it. It doesn't move in line. It doesn't move in a linear way. It doesn't move in a very straight line or in a form that will be more clearer. So because the forex market moves in forms of, or in terms of rough or zigzag, we use a tool known as moving average to smoothen out this price fluctuations that is a bit zigzag in the forex market. We use this moving averages to smooth out the price so that you actually be able to tell the direction of the market. And so if I would go straight to the MT4 and show you a clear explanation of what we mean by this first point, then what we want to mean will be like this. What we are saying here is this, okay? We are saying that looking at this over here, as you can see, the forex market is just being choppy. This is GBP share, moving up, down, down, up, and in that order. Look at the choppy way the market is. And because the price of the market or these candles or whatsoever is so choppy, it becomes very difficult to sometimes know the direction of the market. And so we use moving averages to determine, to smoothen out this chart we are seeing. We smooth out to know exactly the direction of the market using moving averages. So the market is very choppy, moving up and down, up and down, up and down. And sometimes it's very difficult to spot or to know which direction the market is going. So we use what? Moving average to smooth out the price to actually determine the direction or the angle at which the market is going. That is all that first point is saying. So remember, we use the moving averages to smooth out price fluctuations to help you distinguish between typical market noise and then the actual trend direction. Point number two. Point number two says that moving averages takes into consideration the average closing price of a currency pair for the last X number of periods. The X there stands for a number. So it could be 10, it could be 20, it could be 50, it could be 100 or whatsoever. So moving averages takes into consideration the average closing price of a currency pair for the last X number of periods. Now, with this point two, I would like to go to the MT4 and explain it better. What the second point is actually saying is that this pair, for instance, is GBP what? Share on 1 hour. So the moving average does something which is very important. What it does is that it calculates, for instance, if you pick the last candle which is formed here, it will pick this last candle's closing price, okay? And pick another candle's closing, the next one's closing price. Pick the next one's closing price. So assuming your moving average that is on the chart has a number 5. What it means is that if it has a number 5, all it wants to say is that this moving average is taking the last 5 candles, their closing prices, okay? It's taking this one's closing price, taking the second one closing price. We are moving backwards, taking the third one, the fourth one, the fifth one. So it means that the line that you will see on your chart is taking the last 5 candles, their closing prices, and then it does its calculation. Out of the calculation, it is able to tell you on average the movement or the average movement of this currency pair, especially with what direction it is going. Does this make sense? So your moving average number that will be used, if you choose 10, it means the moving average that you are going to see on the chart very soon, if the number is 10, it means it is going to calculate the last 10 closing price of the last 10 candles. And this is on 1 hour. So it's going to take this one, 10 of them, and do its calculation and give you the moving average, the average at which the price is moving. Are we good? So if your price or your number is 50, it means it's going to calculate the last 50 candles, the closing price of the last 50 candles. And when it does that, once it calculates all that, it will give you the average movement of the currency pair. Are we good? No problem. If this is still not clear, I'm sure as we move along, things will get clearer. So that is what the second point here is saying. So a moving average takes into consideration the average closing price of a currency pair for the last X number of periods. So the X there stands for a number. So if it is 10, it will be for the last 10 number of periods. So it means the last 10 candles, its closing prices. It adds that to give you the average movement of the currency pair. Are we good? Now, let's look at point number 3. Point number 3 says that moving averages are just like every technical indicator. So like every technical indicator, a moving average, which is an MA, is used to forecast future prices. Now, we use the moving average to forecast future prices. But there is a warning. That is the 4th point. Listen to this warning carefully. Moving averages do not predict price direction. Instead, they define the current direction with a lag. Listen carefully. Moving averages do not predict price direction. They do not tell you where the future price will be going. They don't do that. They only tell you the current direction of the market with a lag, which simply means that the moving average is doing past calculations. The moving average is actually doing a calculation of what has already happened in the forex market. The warning is what I'm explaining. So the moving average is actually calculating what has already happened in the market. It is analyzing the past data for you. That is what the moving average is doing. Because the moving average is not going to calculate the current the current candle that is being formed. No, it will only calculate the past ones that has formed, or the past candles that have formed, their closing prices. Because if a candle is being formed, until the candle is closed or fully formed, the indicator, which is a moving average, will not be able to know its closing price until the candle is closed. So the moving average indicator that you will have on your chart is to give you the current direction of the past candles. That is what it does. It gives you the current direction of the past candles. So it is just printing the footsteps of what has already happened. Do you get it? But as traders or as businessmen and women, we know that if you really want to know what will happen in the future, those of us who have done research or gone into research or done some kind of project work where we need to gather some gather some facts and figures, we know that once you gather those facts, you analyze them, and whatever will be the outcome of the analysis, you base on that outcome to predict what might be happening in the future. For instance, as a doctor or as a nurse, the nurse will examine your records, what has been your past history or your history in the past. So your history in the past with regards to what you eat, how you were feeling, and what is happening in your body, and whatsoever has happened in your body, as to whether you have gotten into contact with any disease or sickness before in your life, will help. So the collecting of those past data will help the doctor or the nurse to be able to make a prediction and to give you a diagnosis based on your history. So the same way research work demands data from the history in order to interpret what the future will look like, the same thing with this moving averages. They only analyze the past data. And once the past data is analyzed, you can use the past data to predict what might be happening in the near future. Am I clear on this? So to make this warning sounds clear, what we are saying is that moving averages, they do not predict price direction or future direction of the market. They do not do that. The moving averages do not do that. They only calculate the past happenings or the past prices or whatever has happened in the past is what they calculate. But as technical traders, we know that once we can analyze that by getting some data, we will be able to, based on that data, to make predictions into the future. So that is why the third point here says that, like every technical indicator, a moving average indicator is used to forecast future prices. So we base on the past prices to forecast or to predict future prices. That is what moving averages do. That is what they do. So they only help us by giving us the past data or the past experience in the market. And once we have that information available, we can be able to use that information to make projections or give a forecast or make a prediction into how the future price might be. Now, mind you, the predictions and the projections you are going to make is not 100% done deal that is what is going to happen. And that is what people do not understand about Forex. People always think that once you are able to get the past data and you analyze, the forecast must be 100% sure. It is not always like that. The past experience or data that you have can only be true or false. It is not a one-time shot or belief or a finite decision that it is going where you have forecasted or predicted. That is why when you go to the hospital and the doctor gives an analysis of your data, and then the doctor makes what we call prescription, or the doctor diagnoses you and gives you some medications, and you go to try them, the doctor will always tell you to come back for review. So the doctor will tell you to come back after a week or two for review, because the doctor will want to examine whether after the 1 week or 2 weeks, the medication that they gave to you are actually working. And if they are not working, when you go back and they realize that the situation is not getting better, the doctor can choose to give you different prescription again. They can choose to give you different medications. So the doctor is not actually saying that based on your past data, it is a done deal that whatever medication they are giving to you is going to work. They are only making predictions based on the data that has been given to them or the data that is available. I am not a doctor, but that is what happens in the hospitals, and not just the hospitals, every field of work. That is what happens. If you're a businessman, whatever happens in 2022, at the end of the year, you'll sit down to analyze and then be able to forecast what 2023 will be. Is that not it? Yes. So there's always what we call New Year resolution. So you sit down to analyze what has happened in the course of the 2022. And as a result of that, you can be able to predict that, okay, this is how my business will go in 2023, or this is how I want it to go, or this is where I think it will go in 2023. So you always analyze the past data to give you an insight or a forecast into what the future will look like. So do not assume that that forecast you are given is a done deal or is 100% assured. No, that is not the case. Are we good? Now, I will tell you the reality as it is when it comes to this channel. I don't play games here because I want to tell you what it is, the reality in the forex market. So this is what the reality is all about in terms of moving averages and any other technical indicator. Whatever other technical indicator you are using, whether moving averages, whether Fibonacci, whether indicators, whatever indicator you are using or whatsoever, this is what it does. Yes, every analysis you will do, this is what it stands for. It is only to analyze the past data and be able to make a forecast into the future. That is all about making analysis. Is that okay in the forex market? So let's continue. From this point, things are getting interesting. Now, this is a typical example of a moving average on the chart. You will see a blue line on the chart. That blue line you are seeing there is a moving average. And it's a moving average with a closing price of 10 periods. So it means this line that you are seeing on this chart is always calculating the last 10 candles. Always calculating the last 10 candles. The last 10 candles are calculated. And out of that, it is able to print itself in a line which is seen on the chart. So this line you are seeing is the smooth out of the price. So maybe the price is here. Let me give an example. Maybe look at where this candle closed. Maybe this was the 10th candle that was calculated. So this is the price of the 10th candle, the closing price of the 10th candle. But the moving average is telling you that, no, this is not actually the closing price. The closing price is somewhere here. This is the closing price where it's supposed to be on the blue line. So the blue line you are seeing is actually giving you the actual average closing price. Average closing price, I repeat. It is only giving you the average closing price and not the closing prices you might be seeing at the down or the top. So this line you are seeing there is giving you the average closing price of the chart you are seeing here. Is that okay? Good. Now, let's continue. Let's continue with the notes. Now, the reason for us using moving averages instead of any or just looking at any price chart is due to the zigzag nature of the price. I've already explained that. And also the fact that trends do not move in straight lines. Because the market is not moving in a straight line and the market is being zigzagged, it has become necessary to get a tool that will smooth out the price for you to get the average price movement. That is why we use moving averages, okay? Or some people use moving averages in the forex market. Now, so by looking at the slope on the next slide, on this presentation, you can better determine the trend of the direction because, as we said, moving average, they smooth out price action. So let's look at that slide that we are talking about here. Look at this. You can see a black line. The kind of 0, 0 you are seeing are actually let's say candles, okay? The 00 you are seeing are candles. And then the line you are seeing there is the average price movement. So looking at the price, the average price movement, the line, it's able to give you an idea that, okay, looking at how the line is going, the direction of the line indicates that maybe this price will go up more because of how the line is currently moving. It looks like the line came from the down part and it's moving up, gradually moving up and gradually moving up and moving up. So one is able to predict that, okay, looking at how this average price is moving, it is possible that it will continue to make its way up. Is that clear? So this is how people use moving averages to do a forecast in the market. Now, generally, there are different types of moving averages, and each of them has its own level of smoothness. And when we say smoothness, we are talking about how close it is to the price. How close is the moving average to the price? When we say close to the price, what we simply mean is this, coming back here. How close is this line to the candles? That is, the candles are the price. So how close is the line to the price, which is the candles? So the smoothness of a moving average will determine how close it is to the price, okay? So we'll be looking at that in detail. So get that in mind, that when we say how smooth a candle or a moving average is, we're actually saying that how close is it to the price, which is the candles. So if a moving average is far from the candles, what does it mean? And if it is close to the candles, what does it mean? We'll be looking at that, okay? So generally, there are different type of moving averages, and each of them has its own level of smoothness. That means how close it is to the price or the candles. The smoother, so when we say the moving average is smoother, what we are trying to say is that it is far from the candles. So when a moving average is close to the candles, that is not smoother. But when we say moving average is smoother on the chart, what we are trying to say is that it's far from the candles. And we'll be looking at these examples very soon. So the smoother or far the moving average from the price, the slower it is to react to the price movement. So what we are saying is that if the moving average is very far from the candles, it means it will take enough time to react. It means that it will lag more. Indicators lag. And remember, this one is doing the calculation of the past prices. So if the moving average is very far from the candles or the price, it means that that indicator or that moving average is lagging a lot. It is very slow in catching up with the price. That is what it means. So when a line on the chart, which is a moving average, is very far from the chart or is very far from the candles, what it means is that that moving average is lagging a lot, or it is very slow. But there are advantages and disadvantages as to whether it is lagging or not lagging, okay? So the smoother or the farther the moving average from the price, the slower it is to react to the price movement. We'll explain that further. Now, the choppier or closer the moving average is to the price, the quicker it is to react to the price movement. So if this is the case, which one is better? Should my moving average be closer to the candles, or it should be far from the candles? Because we are saying that when it is closer to the candles, which is the second point at the down here, when it is closer to the candles, it reacts to the price quickly. It gives you quick answers, or it gives you quick suggestions. It gives you quick suggestions as to what to do. And also when the moving average is far from the price, it is very slow in giving you answers. Do you get the explanation? When the moving average is close to the chart or the candlesticks or the price, It gives you quick answers or quick decisions. Let me put it that way. When the moving average is close to the candles, it gives you quick predictions. And when the moving average is far from the candles, it gives you slow, or it takes time to give you prediction. So which one is better? Is it the one that is closer to the candles or the one that is far away from the candles? So let's go ahead and we will appreciate. Now, each of them has its advantage and disadvantages, okay? So let's continue with the note. So now this is where we can decide which one is better. So the first point here says that when a moving average is closer or shorter in the length to the price, it means fewer data points are calculated in the moving average. So it means maybe the moving average is using a fewer point, like maybe 5, 10, 15, 20. So the higher the number, the far the moving average will be from the candles. The smaller the price, the closer the moving average will be to the price or the candles. Are we okay? So the smaller the number, the closer the candle and the moving average will be. If the number is very small, 5, 10, 15, 7, whatsoever, 9, 20. So the smaller the number, the closer the moving average will be to the candles. And then the bigger the number, the wider the moving average will be to the price, okay? The second point says that when the moving average is very closer to the price, this will reduce its usefulness. Listen carefully. This is where you need to catch the whole trick. We are saying that when the moving average is closer to the price, which is the candles, this will reduce its usefulness and may offer less insight into the overall trend of the market. So you want to know the overall trend of the market, but the moving average is very close to the candles. This is going to reduce its usefulness. It means it's going to be giving you decisions quick. The line is going to be very quick to draw on the chart. And you will see the line being zigzag on the chart. You will soon see what I'm talking about on the chart. Let's not rush. But what if it is far away? We are saying that when it is close to the moving average, or the price is close to the moving average, or the moving average is closer to the candles, it gives you quick decisions. It gives you quick predictions, which might end up giving you some false predictions. That's what we want to mean. So at the end of the day, you may not be able to get the overall picture. You may not be able to get a clear picture. The usefulness of the moving average may not be so unique. You may not get it clear. It will be very, 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 very difficult because it's giving you quick suggestions, giving you quick decisions. But the third point says when the moving average is far or longer in length to the price, it means more data points are calculated in the moving average. So it means more numbers are used. So it could be 50, 100, 150, 200. So the bigger the number, okay, the wider the price will be from the moving average. So we are saying that you should know that when the moving average is far, bigger numbers are being used in terms of calculation. And if that's the case, this will increase its usefulness. Remember, the first one will reduce, here it is, the first one will reduce its usefulness, but the second one here will increase its usefulness in dictating the overall trend of the market. But, don't forget, but, there's a caution there, but may become too smooth that you won't be able to dictate any new kind of trend or change in trend early or on time. Now, we are saying that when the moving average is close to the price or the candles, it gives you quick answers or quick predictions. And some of them might turn out to be false. And we are saying that when the candles are far from the moving average, or the moving average is far from the candles, it may give you good overall idea about the market. But the problem is that sometimes when the price is about to change in direction, because the moving average is very far from the price, it may not be able to dictate that new trend on time. Assuming the trend is up like this, okay, and then the trend is about to change from going up and then come down. Because the moving average is very far from the price, when the U-turn of the trend is happening, this indicator, which is down here, may not be able to give you a quick prediction. It may not be able to give you a quick reaction for you to know that, okay, at this level, the trend is about to change. So that is the problem with the moving averages that are far from the price. So they are not able to dictate any new kind of trend or a change in the trend early. They are not able to do that on time. But there's one that is closer to the price, may give you that very early. It may give you that quick U-turn or a change in the trend. The closer moving average may be able to give you that very early. But the bigger or the wider moving average may not be able to do that on time. But like I said, they all have the advantages and disadvantages. The problem with the closer one is that sometimes it will give you some false directions. This one will filter out those false directions. But when a new direction is able or is about to form, the longer or the wider one will not be able to see that on time. You will always see it very late. Whilst the one which is closer may give you that one very fast. But that one too, the problem is that sometimes it will give you some new directions which may be false. So then again, which one is better? The question still stands. The question still stands. Which one is better, my people? Now, let's continue. There are two main types of moving averages. And in my next video, I'm going to explain these two moving averages. Now, these two moving averages are the simple moving averages and then the exponential moving averages. Okay? Now, before I leave or before I end this video, let me go back and explain this point here about the closer moving average and then the far away moving average. Okay? Let me explain that before I end this video quickly. Now, this is, I'm still using this chart, okay? Now, if you want to bring a moving average on your chart, there is a way to do that. You can either come to the indicators column here, okay? The indicators column over here, at the down here. Okay, maybe let me draw. At the down here, the navigator panel here. You can either come here and look for the moving averages and plot them on the chart, or you can come to the top here and come to insert. At the top menu here, you see insert at the top here. Those of you watching the top left corner, you see insert. After file view, you see insert. So these are the two areas you can go and bring your moving averages. So let's do that. First of all, let's go to the navigator panel here and look for trend. We look for trend. So under trend, when you click on trend, you will see average true direction, moving average. You see moving average here. So when you click under the trend indicators, you click on moving average here. Once you double click on it, it will appear like this. Now, how many candles do you want this moving average to calculate? Is it going to be 50? That is the period. So the period you see here stands for the number of candles you want it to calculate. And we said that the smaller the number, the closer the indicator will be to the price, which is the candles. The bigger the number, the wider the indicator will be to the price or to the candles. So if I use this 50 here as the period, it means it's going to calculate the last 50 candles. If I put 25 over there, so assuming I change this period over here to maybe 25, it means it is going to calculate the last 25 candles. The calculation is going to be done by the last 25 candles, the last 25 candles, the last 25 candles continuously. Whatever number, if I put 100 over here, it means it's going to calculate the last 100 candles, the last 100 candles. That is what its calculation is going to be. Now, after the periods, the next thing to look at is the MA method. The method is what type of moving average do you want to use? The MA method that you see here, the MA method you see here has to do with what type of moving average you want. Do you want the simple one? So that you see currently it's on simple. So it means if I leave it on simple here, it means it's going to be a simple moving average. When you click here, there will be a pop-up. We have exponential also here. So it's either you are using simple or exponential. The smooth and the linear ones are just subset of these two, the first two. That's why we said we have two major moving averages, which is the simple moving average and then the exponential moving average. So is it a simple one you want to use or the exponential? I haven't given you the note on that yet, or I haven't explained those ones yet. So that video will be the next one after this one. So the next tutorial video will be on simple moving averages and then exponential moving averages. But for now, let's just leave it on simple, okay? For the purpose of demonstration, just leave it on simple for now. What color do you want to use? So you can switch here and change the color to whatever color you want. So let's assume we are leaving this one on 100. So we want to change the color to red. And how thick do you want the line to be on the chart? So you can choose the thickness of the line on the chart by choosing any of this, okay? So maybe let me choose this. All right, now the period is 100. So I click OK. So this is 100 simple moving average. Look at it. This is 100. You see it on the chart? This is 100 simple moving average on 1 hour. Now, if I change the chart to 4 hour, this is how it will look like on the 4 hour. If I change it to daily, this is how it will look like on the 4 hour. Sorry, on the daily time frame. If I change it to weekly, this is how it will look like. If I change it to monthly, this is how it will look like. Okay, so this is 100 moving average. Let me take the chart back to 1 hour. Now let's go and put back again another moving average. So you come back, you click on moving average here. Now let's change the number to 20. What? Let's just use 20. Let's change the color to maybe blue. Then we'll click OK. Now this one